Casper Wang joins us today from Menlo Park. He's a partner at Sapphire Ventures, where he focuses on growth stage investing across enterprise AI, cybersecurity, infrastructure, and broader enterprise software. Casper has backed several breakout companies that have reached unicorn status, including Huntress, Sierra, and Glean. Before joining Sapphire, he was a tech banker at B of A Merrill Lynch, working on major IPO and M&A transactions. He also co-founded Etch.ai, a personal CRM incubated at Berkeley Skydeck. Casper has been recognized as a rising star by Business Insider and named to Silicon Valley Business Journal's 40 Under 40. Casper, welcome to the show.
Thanks for having me here, Nick.
It's such a pleasure, sir. I hear it's a very nice day in Menlo Park, so I'm jealous. But talk through, your backstory and your path to venture.
Yeah, certainly. And it's absolutely a gorgeous day here in Menlo. So like you have laid out already, I went to Berkeley for college. Actually, at Berkeley, started the company called Etch. That's a personal CRM sort of management software where it's you and I who can use this as a way to track our contacts. And maybe before the podcast, the idea was very much I can talk to Nick about 3 top topics and what should I talk about. And I actually raised a bit of money then. But we launched an app store and, honestly, it didn't really take off. So I had to make a pivot, and folks don't really know what to do in college. They tend to go to banking, and that's kind of what I did. And, and like a lot of folks in banking, it's not really their full-time career for the rest of their lives. And I was fortunate enough to be on the IPO of a company called MuleSoft. And CEO introduced me to Sapphire. And for those who don't know, MuleSoft was a big position of Sapphire's back then. And the company went public, and Salesforce bought them for, I think, $6.5 billion. And it's been a little over 7 years, and I haven't looked back.
It's amazing. One of the very first interviews I ever did 11 years ago was with Ann Winblad. Homer Winblad. And on the show, she talked about her, at the time, fairly recent investment in MuleSoft. So that was pretty cool. Tell us a bit about, the approach at Sapphire. What do you focus on, and what is the thesis?
Yeah, for sure. So we are a growth stage. Generally, growth stage is a pretty big term. The way we define this is post-product market fit, right? So not just 3 folks in a garage sort of product market fit, but really we see some sort of repeatability from a customer buying behavior perspective. And the other thing that we focus on is really B2B, right? So we focus on businesses that are selling to business. It could be B2B2C, but it has to be, B2B to begin with. So we focus on sort of, 1 is growth stage and 2, B2B. And the way we think about backing our portfolio companies is we really try to back company of consequence, companies that today are sort of the category leader of their category, or they are an emerging category leader, right, of an existing category that have the potential to be one of the greatest software companies of all time. And that's our model. And we try to be active on your cap table too. So we tend to lead 75, 80% of the rounds. Not dogmatic about it. We want to be involved with the right companies, but we really try to be, the most value added investor on your cap table.
How do you feel about categories that are known and are like existing budget items in the enterprise versus category creators, very disruptive and brand new categories? How do you think about that at the investment stage and sizing up markets and making investments?
Yeah, Nick, it's one of the hardest questions for any investor to answer, frankly speaking. The way I think about this is if there is an existing budget, there's a clear target that you have to go after. Generally, the path to, billion-dollar ARR or a really big outcome is more laid out, right, versus category creation. And oftentimes when you're going after incumbents, and the way I think about this is the pro, or one of the pros is certainly the target is a lot more clear that you have someone to go after. On the flip side, the issue is you have this 700, 800-pound gorilla in the room, and it's creating sometimes what I would call consumer surplus problem in enterprise software, right? What I mean by that is, you can't stare at my room, but I have a big TV here. And you look at TV prices, right, from the 1960s to the 2000s, this would have cost like $100,000, I think, in 20 years ago. Now it's probably, I don't know, like 10 grand or something. And the problem similar to you with an existing category is you have incumbents who are pricing products, right? The Microsoft of the world at a pretty aggressive rate. So no matter how strong and how good your product is, you have a benchmark in terms of how much you can charge from a velocity standpoint. On the flip side, a category creation story, I would say the issue with that story oftentimes is the category is not here. The puck is coming, but it's not exactly here yet. So you have to be patient around this, right? Sometimes it's a product issue, sometimes it's a technological issue, sometimes it's a go-to-market issue. But once the switch is flipped and you're the only sort of game in town, it actually is a really good dynamic because incumbents don't think your category is big enough, or they don't think your category is real. And you can sort of have this time to really define and, in some ways monopolize the entire category, right? So, there's no one way to think about it. I think we backed, companies like Looker, who are more in the business intelligence side of things, very much existing category, new approach to go after an existing budget. And we back companies that are sort of more on the category creation side of things, right? So there's no one size fits all approach to what we do, and we kind of evaluate on a case by case approach.
I want to talk a bit about AI and how quickly companies are expanding. We're seeing these growth stage companies now hitting 100 million of ARR. Previously, a very difficult milestone to get to, and now we're seeing it happen inside of months instead of many years. And also, we're seeing that happen without sort of the corresponding massive burn and huge, staffs that were once considered normal. So are we going to continue to see capital efficiency metrics accelerate with these advances in AI?
Yeah, I would say, first of all, I think AI certainly makes all business models more efficient, right? And that's the promise of AI, and I think that's playing out in a real way. That being said, I do think the capital intensity question is much more of a business model question versus, hey, whether you're AI or not, right? The way I think about this is if your distribution model requires you to sell to JPM, Bank of America, Lockheed, Nike, you had to wine and dine the key decision buyers. No matter whether you have AI or not, you're going to spend the expense. You're going to wait until the procurement cycle is ready. And that's just a more expensive sales cycle. On the flip side, once you have those customers, if your product is real and good, it's sticky and your lifetime value is a lot higher and the quality of revenue is higher, right? Now, a lot of AI companies, like you mentioned, have taken off in a massive way. And this word kind of has gone out of favor, but 3-4 years ago, who were chatting, we'll be chatting about PLG a lot. And in some ways, those names are more, PLG targeting consumers/prosumers, right? And that's just a very classic and very different distribution model, right? And I'm sure we can touch upon this, but those are folks who are swiping a credit card, coming to your website, clearly see real product market fit by paying, but they could exhibit very different behavior than a JPM who's buying an ELA on your platform, right? They could be churning next week or next month. So there are different trade-offs to it. And there's no doubt, again, AI is making things more efficient. But I do think whether, a business is capital intensive or not, the better predictor is actually the distribution model versus whether this business is AI or not.
What about a company like a Bridge, for instance? I don't think you're invested, but they're doing a lot in healthcare. I just had a podcast with Samesh Dash over at IVP about them, and they're selling into enterprise, into healthcare, and they're working with Epic, and it's like historically long bloated sales cycles with some cloud software, some on-prem, but they've also reached that $100 million mark, I think inside of 3 years. It's been pretty fast.
Yeah, totally. I would say, again, capital intensity and velocity, two things that AI has turbocharged, right? And we're not investors in a Bridge, so I, wouldn't comment on the specifics there. I would say, there's certain unlocks as I think of the story from outside in, right? Whether it's the tech partnership they've established with Epic, right? That's, I think, turbocharging. If I were a buyer, all my days in Epic, it's pretty easy for me to adopt this. And on the flip side, like we talked about earlier, AI as a budget item is so top of mind for CIOs and users from a tops-down perspective. So if the entrepreneur is able to build a product that actually resonates with the end user, and you already have tops-down approval, it's a very sort of magical moment for the company, right? From a velocity standpoint, because you have tops-down buy-in for folks who are motivated to come in and buy the product. And, if you actually build a product that users love, it's sort of the right and the best combination, both worlds. And that's where we see sort of increased velocity of things.
Earlier, you talked about pricing benchmarks, and then you also mentioned revenue quality. Is there a risk to pricing durability with AI startups, now that they can be copied and competed with more readily?
I think 100% yes, if that's the thesis, right? If the thesis is, hey, you build a product that could get commoditized, I think 100% it's probably easier. But that being said, I do think AI companies and AI software companies, AI B2B companies, just like non-AI B2B companies before them, if you just stop evolving your products, you're going to face competition, right? The famous saying, your margin is my opportunity. I think that's happening real time here in Silicon Valley and outside of the Valley, as well as more and more, entrepreneurs start companies. So I do think there's a dynamic here where, regardless of whether you're AI or not, regardless of whether your first product actually hit that, magical product market fit benchmark or milestone, you still need to keep evolving the product to keep up with competition, because the velocity of competition, to your point, Nick, it's just as easy as ever to build a company. So I do think, again, going back to my point, like, is the moat in AI worse than before? Not necessarily, in my opinion. But if you don't evolve, I do think, the pricing power that you have will certainly be competed out.
How are you thinking about defensibility these days, right? We see a lot of startups grow fast and then churn fast. And I would venture to guess that most of those are because the product is insufficient in some way. But in some cases, they're being displaced by competitors. So, what are your thoughts on defensibility?
It's really hard and really broad question, Nick, because sometimes I think defensibility is also a question around, why is this company growing fast, right, in the first place? Is this because of true product market fit, or is this because the business is selling $1 for 90 cents? And sometimes the story is murkier, right? I'm sure on the consumer side, we've all had experiences where, you used to be able to DoorDash a meal and have DoorDash pay us a coupon, right? And back then, the unit economics is probably not that great for the company. But lo and behold, now we're in 2025, right? The business is a really profitable compounder in the public markets. So I do think, the most important thing is to figure out whether the business has true product market fit, right? And how durable that product market fit is. And in DoorDash's example, that's probably, a scale question, right? The tech backend, but also a scale question. They scale to a certain point where they're in all the major markets. In a lot of B2B software, it could be a brand thing, right? I'm sure we'll talk about cybersecurity later, but it's the entire cybersecurity selling is built on trust to some extent. So if you hit some escape velocity, it's much easier for you to drive network effect through trust. It could be, certain key partnerships and choke points that you've unlocked, through partnering with certain players. But I would tend to say that there's not necessarily, like, outside of the 5 big labs out there, like, there's not a quote unquote rocket science technological problem that nobody else could have thought of. And the competitive advantages of this era, in my opinion, it's actually pretty similar to the classic software winner stories, in my opinion.
When you mentioned true product market fit, versus selling $1 for 99 cents, can you unpack for us some of the metrics outside of growth that you prioritize in order to assess true product market fit?
Obviously, churn and whatnot, backward looking is good to see. But I think the number one thing I really look at, and this is not something that, by the way, I paid that much attention to pre-AI, is really engagement of this tool, right? I generally don't, I care about average for sure, right? If your average looks more like a consumer product, that's fantastic. And in some ways, that's, the Glean's case, right? But if it doesn't have to be, right? Because I do think the things I care the most about is, one, power users. So people who love you, like, are they on this 24/7? And then the other pocket of folks who are going to be more churning is what I would call non-consumption, right? Imagine, if you're a coding tool, you have great product market fit, and now you have all kinds of non-engineers coming and build. Yeah, of course, they're going to be more churning because building a tool on top of the platform still takes mental energy, still takes time. And if I were not an engineer, I would take a break week 2 to week 3 before I come back again. But I think seeing sort of how that user group behave, right? Like sometimes is there a smiley curve here, meaning they churn early on and they come back? That's something that I really try to dig in. So one is just the engagement of power users, and 2 is there a smiley curve among the user group? Because I expect churn, by the way. Like if you build a great product in AI, it almost like you'll have churn because you have all kinds of people coming who are not your ICPs, who are trying your products. But I think the more key thing is there a smiley curve? Are they coming back later on? That's almost more important than if they're churning or not in the first place.
What's a healthy percentage of power users relative to total?
I think the 20-80-20 rule is, sort of accurate in a lot of cases. Sometimes you have, the editor/reader sort of dichotomy, right? The editor who are in it, who are constantly tuning and fine-tuning things. Those are probably more in the 20% of players versus 80. So that's kind of the benchmark I go through. But in general, it's hard to say, right? It really depends on from a case-by-case standpoint. What I would say is, like, if there's a certain critical mass of folks who really love the tool, I do think there's something there is how I phrase it, and I try to dig in more.
We're seeing some AI fatigue setting in across the enterprise sector. Forecasts are being revised down, and yet still lots of demand in the private markets and the ventures sector. What do you think we should expect from the buyer set, on the customer side, and then also the investor set going forward?
It's a really good question, and also tough to answer. I think from a tops down perspective, it's just so hard to predict where and when, right, we're going to have that moment. I think it's going to be more gradual than, say, when ChatGPT first came out. We're going to have this AI demand meet supply magical moment. I would tell you that, as somebody who spent a lot of time in software, the way I think about this is, so you look at S&P 500, which is the 500 most important companies out there. There's probably single digit, right, not counting Microsoft and those conglomerates, single digit of pure play software companies within that index, right? Which just feels low to me. Like I think about the impact, right, from a productivity perspective, from a lot of different angles. There should be more S&P 500 software companies getting created over time. And so I think, like, from that tops down perspective, I'm certainly very bullish on that. And secondly, Nick, to your point about, hey, the dichotomy between private and public, right? I think one thesis and one hypothesis I have is a lot of the AI innovation is truly happening on the private side. There's obviously a lot of other, undercurrents around, hey, companies not going public at 100 million ARR anymore. So you have more companies staying on the private side. But I think the truth is, whether it's from talent perspective, whether it's from a, innovator's dilemma perspective, there's just more great AI strategies, companies, products on the private side than the public side. So that part, you can also see why, sort of there's a dichotomy between private AI valuation and perhaps the public valuation.
Yeah. When it comes to talent, do you find that it's increasingly more difficult to attract top AI level folks in this environment to companies, or is it becoming easier? Part of the reason I ask is because the supply side of top end talent is thin, right? It's not expansive. And then also the public companies, there's a lot of incumbents out there that can pay huge dollars for those types of folks. So how are you seeing your companies attract talent, and has it been more challenging or easier than expected?
Yeah, so this will be a pretty gross generalization in my opinion, but if I just draw a line, right? So we have the true AI talent who are building large language models. I don't think I'm telling my companies to go after those people, right? In rare cases maybe, but we're talking about, a very small number of people who knows LLM, every lab on the world, you know, OpenAI, Meta, Google, everybody's going after those people. And in general, unless you're building a model, which I would say like for most private companies, it doesn't make any sense to build a model. You generally doesn't make sense for you to go after those people. So there's that dynamic there. And there's a second group of folks who are, traditional great product people who know how to incorporate AI into the design of your products. And it's much harder to tell who are those people because, you can't just ask and put a job description asking for 5 years of LLM experience because, ChatGPT came out in November 2022. But I think like finding those really killer product people who knows how to integrate, who knows where the puck is going, who knows like what models they want to integrate in your product is more important than finding the first group of folks, right? Now, the other point that you touched on, Nick, was, hey, all these very big firms are throwing dollars at those talents. I do think a very interesting thing, I think like that is where you probably see some personnel changes, right? You saw that at Gemini, you saw that at, Meta's AI organization. A lot of times the tension is you have a VP level people who's been at Meta, Google for 17 years. And they're more than qualified, by the way. Great people probably. Don't know them, just outside any observation. They came in to this completely new thing, right? And they're making much more than the people who are actually doing the real work on LLM. And that's a real tension, to be honest, right? Versus like you go into an OpenAI that's much flatter, right? So that's, I think, from a talent war perspective between the Metas, the Googles who have a huge balance sheet and a startup that's building models, I think oftentimes, that's a very attractive thing for the talent because those organizations are a lot flatter than an organization where, again, it's really hard to throw away the salary scale, right? It's almost like a sports team. You have this rookie who's playing a completely different game than a veteran player who won you 5 Super Bowls. Like, you're just not going to cut this person who've done so much for you and pay this rookie more, right, from a salary scale standpoint. So I think that's actually a very interesting inherent conflict that's happening real time on the AI talent war side of things.
What sort of advice would you share with the founders out there that, are running an AI startup? Maybe they're planning to raise in 2025. How should fundraising narratives shift and amidst these investor expectations that are kind of evolving on the fly?
So first of all, I think all you need is one term sheet. Okay. So that's number one thing. I wouldn't go too deep into it, but all you need is one. There's no point of collecting a bunch. All you need is one, which makes that one so much more important, right? Which is where I think the unique thing about AI, and that's my personal hypothesis, I don't know how this will play out, is I think the company would look very different at 1 million than 10 million and at 10 million than 100 versus the prior gen of SaaS, right? And that second time much more shows up, build the same product, next gen of a sector that they've done before, and the company looks exactly the same, at 50, 100 down the road. This is a very ever evolving thing. So I think like my best advice is probably pitch something that you truly believe in, right? Pitch the vision that you really believe in. You don't need to pitch exactly what you have today, but pitch something that you really believe in and find someone who truly believes in the vision. Because I do think this journey is going to be more turbulent than, again, a traditional SaaS journey where investors show up quarterly and they care about 5 metrics and afterwards just going off to the races, right? I think like there's going to be a lot more iteration, especially on the earlier stage of things. And given the velocity of where things are, I do think like it's important for every entrepreneur to spend the time and find folks who truly believe in, who are truly bought in to their vision as part of the board and as their lead investor.
Do you typically establish that fit in the intro meetings and the early meetings with the founders? Or do you think founders can identify investors who are bought into their vision from afar, maybe by reading their content or other things? What do you suggest for founders that are looking for investors that might, share this vision?
I think those are great ways to ramp up, right? Reading about investor from outside in, doing some references outside in. I don't think there's anything that replaces in-person interaction, shaking hands, more old school, but sit down, share a meal, talk about things that are not work related, right? And especially like, are they steady enough, right? One of the things, in my opinion, the feature and the bug of private markets is once you're in, you don't have liquidity, right? It's not like, oh, you can get out. I mean, there's secondary funds and whatnot, but like generally you're in for the long haul. And whether the company has a good quarter, bad quarter, that's the person you have on board. So do you have a steady person or steady voice in the room? I almost feel like that's more important than, again, it's harder to assess, but that's probably more important than how you feel, right? In the moment of signing the term sheet, like whether it's a big brand name versus not. So that's kind of how I would think about it if I flip the table and sit on the other side.
So Casper, let's talk about cybersecurity a bit, right? It remains an evergreen category, but with threats growing faster than budgets, what advice matters most for the cyber startups?
Yeah, I would say, hey, the items I said above matters. In cyber, the two features and bugs of this category is really, one is lower velocity, right? Which makes sense. Again, I think cyber is more and more important by the day, but it's not more important than your business priorities, right? Like if you're in the way of building a products, CISO going after, building products, you're always going to fail as a CISO. So I think that's why it's a low velocity category and people really value trust and people really value sort of network effect, right? Like are my peers using this product or not? So I think like that's a very important thing to sort of remember. And two is just the catalyst, right? In this category is also important because oftentimes you show up in cyber, people don't rip what they have out. They're doing a layer cake approach, right? They're like, oh, we've got this thing and instead of ripping this thing out because they have 20% value, they could potentially, preventing me from getting breached. Let's layer on a new thing on top. So then the question becomes more, why now? Like, why is now the point for you to be there, right? And, RSA is around the corner in 2 weeks, and I would encourage everybody to go and walk around the RSA floor. Your chances of finally picking a great company is just as good as anybody who doesn't have the context here because there's so many companies out there. And by the way, CISOs have such a hard job, right? They're putting out fire every day, and they're not sitting here pontificating on what the future of cyber is. So I do think that the solution has to show up and have a really compelling why now reason, right? And usually the why now is created by the product, by the category, but also by old school go to market as well, right? So again, just a very unique idiosyncratic category in software, and I think like being aware of why now is very important for entrepreneurs to know.
Speaking of why now with AI happening, of course, and in the cybersecurity cat and mouse game always happening, are you seeing certain methodologies or certain approaches and frameworks winning in cyber right now? And conversely, what are some maybe older methodologies in cyber that could become obsolete?
My view is actually the more things change, the more they stay the same. I talk internally a lot about sort of my personal focus now is actually back to basics. I think, instead of sort of chasing an AI application that's going to be built maybe 3, 4, 5 quarters down the road, who, by the way, your eng team probably doesn't even know what the architecture really looks like. Let's actually focus on shoring up, the key things that we have today, right? The identity, the parameters, cloud security, and make sure that everything that we should have cleaned up is cleaned up. And by the way, Nick, like you'd be surprised to know that how many things that are out there that are just not cleaned up, right? They're just not threat vectors, but they could be a very important threat vector as AI becomes more prominent, as attackers become more sophisticated. So I think this idea about getting back to basics is really important to me. And I would probably not use the word obsolete to describe some of the more traditional companies. Now, I would say, there's probably too many tools on this layer cake that a new vendor could show up and potentially consolidate some of those tools, right? That doesn't mean you have to show up and pitch a completely new thing that CISO hasn't even heard about. In fact, I think that would, like cyber buyers tend to be the most cynical people ever because they've been pitched so many times on things that didn't work. So I wouldn't actually encourage folks to go in and pitch AI all the time, right? Because for every good AI tool, there's probably 10 that didn't work or 100 that didn't work. So I think that's also another pretty interesting dynamic here as well. I would say, if I say one area that's becoming more and more important and interesting, it's probably the data security side of things. AI needs data to work, and majority of the time, the enterprise data security posture is not where the age of AI needs them to be. I'm biased. I led the last round of a company called Sierra that helps, companies address, data security risk and remediate some of the data loss issues. But, I do think like if I had to pick one, that's certainly, an ever increasingly important issue in the age of AI.
Love it. Casber, in growth stage investing, one must weigh metrics, pattern recognition, market forces, balance everything with gut instinct. What are the most critical factors at the growth stage that consistently signal outsized potential to you? And I know you're going to have to generalize, but give us your thoughts.
Yeah, we had talk about it. So honestly, my answer would be, I do think a lot about competition and competitive intensity. And again, if I were early stage investor, I wouldn't be thinking about it because I feel like you want to take the glass half full view. As a growth stage investor, I do think it's super important, right? When I get in, not only I want a company to be 100 AR, I want a company to be 100 and growing fast. And sometimes the other players in the room kind of determine the ceiling of where this company could be, right? At least the first core product could be. So I do spend time thinking about the competitive intensity of the product, right? Oftentimes, like when I think about, great companies that have great promises that didn't really achieve, again, still great outcomes, but didn't achieve what they really wanted to achieve, generally there's some sort of competitive, intense competitive issues in a broader space. And sometimes it's consumer surplus, right? Like you have, people going out here handing out the software in your category essentially for free. Like it's hard to maintain a strong level of growth, if that's the intensity you're facing. Again, it's not a static view. It's just something that we consider, right? It has to be factored into other things, product founders and whatnot. And then the other thing that we had touched on is because of this, and that's my thesis too, is a lot of big winners actually not obvious at all early on, right? Like, Figma for design, or even GitHub back in the days for developers, right? Like the long wisdom is the wisdom that's been around is like you can't make money from developer tools, and because developers are not willing to pay, right, for a lot of tools. They'll just go in and download some open source software. And so I do think like those are the factors that perhaps make that sector less attractive, right? Or the sector's not defined, category creation, like nobody knows. So it's hard for a team at Microsoft to sit down here and be like, I got to build a better product than, what is the sector again? So I do think like that's why some of the biggest winners are in sectors where, again, it's either it's infancy, it's not defined, or it's a category that people don't think is attractive. And I do think that has a point linked back to the competitive intensity point as well.
How do you measure competitive intensity, during a diligence process?
I do ask a lot of customers to talk to, again, as part of the process, we talk to a lot of customers. I do try to find who the end buyer is and try to ask them, like, what exactly are you willing to pay, right? Because I think, the obvious answer I would be getting is, what you're willing to pay, right? Like, if we 2x the price, would you turn or not? But the less obvious answer sometimes is this buyer the actual user who's experiencing the pain, right? Sometimes those are two people. The people who are using the tool, who are experiencing the pain, are different than the buyer.
Yeah, right.
And that's, in some ways, again, plenty of counterexamples of why this could work as well, but not as ideal if you have one person in the room who has the budget and who has the pain at the same time, right? Because they just be like, yes, we'll be willing to do it, right? Versus you have to go convince someone in the different department to buy the tool here. Because, on the way down, right, when budget, sort of contracts, you're going to have the issue of somebody who's fighting to keep your tool doesn't really have the budget. They have to convince somebody who has the budget, right? So I think like the second level thing I try to tell is if this tool has this dynamic of the buyer also has the pain as well.
Yeah, it's like the workflow issues versus the spreadsheet issues, right? Like in a previous life, I sold an analytical device, and my buyer was, plant manager for like a water facility, and he wanted much better data, cleaner data, accurate data, GPS stamp, time stamp. But the users wanted ease of use and efficiency. The old model was very inefficient. And so it's almost like you have two different customers for something like that, and it can complicate the process.
That's right. It doesn't mean that you can't win. It's just more complex. One more thing to take into account, right?
So let's talk about AI agents a bit. It feels like every other article I read is about AI agents these days. Big storyline is AI agents embedded at the application layer are kind of the next big unlock. Give us the bull case for that thesis, and how does it reframe where enterprise value will accrue in the AI stack?
Yeah. So the way I think about this is, first of all, the common narrative today is AI agents could do things that human doesn't want to do, or the toil that people don't want to touch. I think that's sort of one view to look at this, because a lot of the software apps today, right, are those CRUD apps where you have a database, you have a middleware, and you have an UI on top, right? Mm-hmm. And then you can go in, point and click, upload my Gone transcript into Salesforce. That's something that every sales rep probably needs to do, but maybe you can automate that in a better fashion, right? Tagging it somehow. So I think that's one promise of agent, which I think is playing out real time now. I actually think what's more exciting is what is actually outside of this CRUD app paradigm, right? Like, what about the 90% of things that's not part of the SaaS app that I can't just point, click, and drag, right? Like, for example, if you and I were working on a project that evaluates the competitive intensity of our competitive products, right? Maybe you have your own SaaS app to go in to download, sales data. I have my marketing data I have to download. And today, how this would work is I email you before I log off tonight, and you get a screenshot of, the BI dashboard. I just screenshot it, and you would Slack me again saying, Casper, what about this bar? What does it mean? Right? So those are 90% of the work, in my opinion, right? In an enterprise, really truly unstructured. So how do you evaluate, how do you use how do you build agentic workflows around this and unlock those 90%? To me, is actually more interesting. Now, I do think it's a harder business problem if you don't try to define it in certain verticals, right? Let's say you're just customer success, you're just sales, versus a horizontal thing that does everything under the sun. But I do think like the bigger value in some ways, and the value that's hard for incumbent to attack, right? Like, think about how hard it is for Salesforce to try to get, some sort of data access within ServiceNow. And first of all, they wouldn't build that product to begin with, right? So those are probably a bigger pocket than the 10% of, toiled work that people don't want to do.
So Glean is now a unicorn. You mentioned Glean before, and they entered the enterprise search category, which was already packed with incumbents, but they still managed to find success and break out. Casper, as an early investor, what signaled that it could not only survive but lead in kind of this noisy space?
Yeah, first of all, I do want to say enterprise search has been around for a long time, but it's not really a sexy category, right? It is today, but it was not at all when Glean was started. And keep in mind, Glean started before 2022, right? Before the LLM days. It is, I would say, like a universally recognized problem, but there just hasn't been any solution that really sort of like scratch the itch or solve, the buyer's problem, right? So I think one of the things that people oftentimes, don't recognize about Glean and some of the other startups, right? We have a company called MoveWorks that's pending, but a $3 billion transaction to ServiceNow that people didn't recognize is they are AI companies, but some of the core technologies they built were not AI related, right? They benefit greatly from the rise of LLM. But in Glean's case, for example, the retrieval architecture about how do you get the right data information from the online apps, those are pretty hard to build, right? Building that middleware to retrieve the right information real time at the right place while looking through who is authorized to glean what information, that's a very, very hard problem to solve. And to me, AI is more of an unlock and accelerator to their problem versus a direct head-to-head competition, right? Now, to your point, like, search was one of the greatest use cases ever for internet. Of course, the first set of use cases that are gaining traction in the consumer and enterprise AI space is search. That's why they're seeing more and more folks coming. But I do think like one of the things that, maybe a little more hidden from the general public is the fact that they have a really great, retrieval architecture, and they spend a lot of time and energy building that prior to the LLM era.
Amazing. Casber, how are recent market conditions impacting your investment strategy?
Well, it does and it doesn't, right? It doesn't because we take a 10-year view and we want to partner with the entrepreneur till a very meaningful exit event, right? Whether it's IPO or hold the stocks post public for many years, or a very meaningful M&A event. So we take a very long-term view, and so the recent event, just like, I don't know, every year there's something that went on, right? Like 2021, there's COVID back then, 2022, 2023, right? Folks remember software was dead, right? So there's all kinds of events going on, and we try not to pay specific attention to one thing or the other. But that said, right, we do, we're investors, entry price does matter, and we do take the view that, in a given time and in a given sector, the broader macro condition and public condition has to matter in our decision-making process. So we do factor those in when we think about pricing a deal and whatnot. But there's not a single sector that we would say, hey, like, we just don't touch because of tariffs. I would generally say we do not touch secular losers, right? We do not touch the sectors we feel like are losing because of AI. Those are the sectors we don't touch. But, I look around software, I feel like every sector will be in some shape or form reinvented by AI. So it's hard to say like, hey, here's a sector that you won't touch, right? If anything, like, we probably won't touch certain companies that are not well positioned in those sectors.
Are there any fundamental changes in the way that you price deals now versus maybe earlier in your career? I mean, pricing always fluctuates. There are multiples in the public markets that some look to, but I'm looking for more like fundamental lessons or learnings that really inform your pricing strategy today.
Man, great question, but also very hard. I do think, again, one's case by case, right? It's easy for me to kind of put out a one-liner to you, Nick, and just say pricing actually doesn't matter if you pick right, or pricing really matters because enterprise always matters. But I think the truth is probably somewhere in between, right? And just by law of physics, pricing has to matter. But on the other hand, if you partner with the right company, there could be multiple points or multiple rounds in the company's life journey that you can make money, right? And by the way, the other thing that people don't talk about is venture investors are terrible people from a pricing perspective. It's hard to price, right? We competitors are not great at pricing, which is VCs, right? I myself as a culprit, I'm not good at pricing, versus your PE folks who are modeling everything down to a T, or public hedge fund folks who you have liquidity, right? They're like, oh, now your stock is 12 times. I got to sell this. Venture folks are not great at pricing because you're the marginal price taker, right, for some of the really great companies.
Yes, right.
So we try not to get overly cute, right? But in some other cases, you can find rounds where we would internally call money rounds, where we feel like, what, this is, for this company, risk reward-wise, this is the best round to get in. Sometimes it's when the company is $2 million. Sometimes it's when the company is 50. So that's where we spend more time thinking about versus saying like, here's a company coming in, here's a waterfall chart, let's plug in 3 numbers and the pricing come out. Because we have to be aware, right? Like we talked about, we have to be aware of competition around us and myself included, my colleagues, my partners included. I don't think VCs are good at pricing at all. And then by the way, that's not a bug for what we do, right? That's more of a feature in our ecosystem, in my opinion.
100%. Yeah, the marginal benefit of 20% probably doesn't matter if you pick right, but if you're picking wrong, you'll be out of business either way. Casper, if we could feature anyone here on the show, who do you think we should interview, and what topic would you like to hear them speak about?
I would feature a public investor to talk about their view on what is interesting to them from a private perspective, and if there are companies that are going public today, like what are the interesting names or what are the interesting trades that we're looking for, right? Like, obviously there's the obvious ones like Stripe or Databricks, but what about everybody else? Like, what are the interesting names that they are excited about holding shares in, and why? What are the key characteristics?
Are there any public investors or analysts in particular that you follow closely?
Yeah, there are. I certainly have friends, and we'll follow up after the show.
Perfect.
I'll send you some names.
Very good.
Yeah.
Casper, what book, article, or video would you recommend to listeners?
For software, I'll just stick to investing because for software, one of my favorite book of all time is Larry Ellison's autobiography. It's called Software. You can probably get a reprinted version on Amazon or somewhere pretty easily. And the thing that I learned the most about B2B is everything that had happened today, right? The MCP that folks are talking about that's so hot in AI, the idea about coordinating different systems, the idea about single pane of glass, all those things were tried, 20, 30 years ago, right? By all kinds of different companies. And they're right or wrong for all kinds of reasons. So I think like digging deeper on the history of lessons of what happened then is super interesting. And you get a sense of like what happened, right? Like Worker stock was down 40, 50 after quarter, like what actually happened there. And I think that's a very good way of getting a glimpse of history and learn more about software.
Perfect. Casper, do you have any habits, tactics, or behaviors that are a force multiplier?
Oh, I don't have an unconventional one. I wish I'm doing I don't know, intermittent fasting or something. I'm not doing any of that. I would say, I think the biggest thing I remind myself these days is I just try to take it one day at a time, right? I do think it's impossible to not have a bad day, but the most important thing I want to avoid is having a bad day, but not being productive during that bad day, right? I do think those days count, and I believe in momentum in startups and in life. So, if anything, I would just say, hey, take it one day at a time, right? The long-term vision is important, but you got to take it one day at a time. Like sometimes there'll be a lot of disappointment if your goal is grand, your vision is grand, but you got to treat every day as a separate new day and take it one day at a time.
I like it. And finally here, Casper, what's the best way for listeners to connect with you and follow along with Sapphire?
Yep, you have websites. Email is just Casper@sapphireventures.com. I love investing. I love software. Love talking about, the history of investing and history of software. So if you just want to chat about investing, different forms, it doesn't have to be venture at all because that's what I do every day. But, if you want to talk about publics, talk about privates, talk about cash flow businesses, I'm all ears.
Perfect. Well, Casper, this was a huge thrill for me. Thank you so much for joining us and sharing your insights with the listeners. I really enjoyed it.
Thanks for having me here, Nick. Really appreciate it.